We're all excited to know more about stock market. For today's video we were going to tackle about a book review about stock market. This book review is all about Irrational Exuberance by Robert Shiller. These are the key takeaways from this book. As Robert Shiller's new 2009 preface to his prescient classic on behavioral economics and market volatility asserts, the irrational exuberance of the stock and housing markets has been ended by an economic crisis of a magnitude not seen since the Great Depression of the 1930s. He shows that if people got into the market at the wrong time, they could have to wait for a long time before the value of stocks returned to the price they paid. He shows similar statistics for real estate. Shiller argues that every time there are booms in stock prices, someone will talk about a new era that justifies the rise in stock prices. One explanation for the crash would be that there was a new era, and as people tried to take the consequences of the new era into account, they would bid up prices too high. One point in the book is that investing in stocks and real estate is not a strategy on which real estate and stocks can count to generate high returns. Even if we accept this claim, we might argue that at least if we put money into the stock market, we can count on getting a return that exceeds the return on bonds. When bubbles collapse, they do so for reasons unrelated to fundamentals. In addition, Shiller makes two other points. First, there is a gap between the collapse and any financial crisis. Second, the collapse isn't complete. Instead, there are downturns and then upturns. Interestingly, when the market goes up, people assume it makes sense because they're making money and like it. But when the market goes down, they think it's an overreaction because they like the higher number better, because that was their imagined net worth. In reality, prices seldom make sense if stocks are valued for any proper purpose. When the market goes up, it's not because of fundamentals. And when it goes down, it's not because of fundamentals either. It's interesting to read Shiller because he only writes about what the market does. He doesn't try to predict what it will do. He doesn't put too much effort into making sense of what has happened in the past. He fundamentally believes that psychology plays a massive role in prices and that psychology is fickle. Until the crisis, efficient market advocates like dismissed the evidence produced on behalf of behavioral finance as a collection of curiosity items of no fundamental importance. That's a much harder position to maintain now that the collapse of a vast bubble, a bubble correctly diagnosed by behavioral economists like Robert Shiller of Yale, who related it to past episodes of Irrational Exuberance, has brought the world economy to its knees. In this book, Robert Shiller explains market bubbles and busts using behavioral economics and the irrational side of investors. He demonstrated how prices change for no good reason, either upwards or downwards. Apart from being a book stock, it's a book about economics' behavioral or irrational side. Robert J. Shiller won the Nobel Prize for his theory on predicting the stock markets. He shared the same Nobel with Eugene Fama, who won it for proving the efficient market hypothesis, i.e., stock markets can't be predicted. So the main takeaway is that it's almost impossible to predict the stock market or pick stocks over the short term. At the same time, it's empirically possible to predict the total market returns over the long term. The financial markets are not guaranteed investment. It is no different from other forms of investments. Stocks and shares can go up and down based on emotional buying and savvy investors. And who are these intelligent investors? These are mafias of investors working together to change prices up and down. And with 24-hour trading and millions of personal investors, stocks are like gambling. That's all. Thank you for watching. I hope you learned many new things about the stock market. Kindly subscribe to our channel and click the notification bell. Also, follow our Facebook page to learn more about the stock market.